Question 41. Which of the following valuation methods is least likely used under IFRS accounting standards? So least likely meaning it's not used under IFRS. We've got weighted average, LIFO, or FIFO. So FIFO and weighted average are both allowed under IFRS, but LIFO is not. So that's going to be our answer since we're looking for that least likely. LIFO is allowed under US GAAP, but not under IFRS. Answer B. In which of the following steps should an analyst most likely ensure that a financial statement analysis complies with code and standards? A. Collecting input data. C. Stating the purpose and context of the analysis. Or C. Developing and communicating conclusions or recommendations. So looking at A. Collecting input data and making sure that we're complying with code and standards, the code doesn't necessarily give us best practices or rules around the how to and doing data collection and input. This is more so just going to be kind of best practices around making sure we're doing that so that we get a good analysis, so that it is the foundation of a good analysis, but it's not necessarily going to be a primary concern of the code and standards. B, stating the purpose and context of the analysis. Again, this is an important step in the financial statement analysis process. However, like the collection of input data, stating the purpose and the context of the analysis is not likely going to lead to any nefarious activity from anyone reading the report yet. And so I think we can go with C as our best answer, developing and communicating conclusions and recommendations. This is where the code is really going to come into place because we want to make sure we're not communicating in some way that is saying that we're going to guarantee returns based on this analysis, or that we are superior for some other reason. And so kind of how we communicate findings is going to be more important than in complying with the code than kind of what the specific analysis and data inputs were. Answer C. Question 43. Biotech Solutions Limited had a weighted average of 60,000 shares of common stock outstanding for the year. Ended December 31, 2016. At the beginning of the year, the company has 10,000 options outstanding with an exercise price of 125 USD. During the fiscal year, the company's market price has averaged 200 USD per share. So these options likely got exercised since we have a strike of 125 and the average price during the year is 200. The company reported net income of 1.5 million and declared and paid preferred dividends of 200,000 for the fiscal year. No other potentially diluted financial instruments are outstanding. Biotech's diluted EPS is closest to. So in the case of options, we're going to be using the treasury stock method, which basically assumes that we're buying back shares throughout the year at the average market price. So at the highest level, our formula for diluted EPS is going to look like this. So net income minus preferred dividends, which is pretty straightforward. We've got 1.5 million, 200,000 preferred dividends. So our numerator will be 1.3 million. And then that denominator, we're going to have 60,000 as our weighted average shares. And then we need to add in the potential additional shares from the options. So let's walk through how that's calculated. So additional shares from the options, the company is going to receive the proceeds from those options times the strike price. So they're going to receive $1.25 million. And then from there, they're going to be buying back as many shares as they can. That's the assumption under the treasury stock method. So they're taking the proceeds from that that they received, buying back at that $200 average market price. So we're buying back at $200 per share. That gives us 6,250 shares that the company can buy. So the number of new shares is all the options shares that were issued minus the shares bought back, which gives us 3,750. So that's going to be added to our 60,000 number to get that denominator. So finally, we get 1.5 million minus 200,000 divided by 60,000 plus 3,750 gives us 20.3922. which is going to round closest to answer B, 20.39. Question 44. Available for sale financial assets are measured at A, amortized cost. We can rule that out. I think we had a similar question earlier. Available for sale is going to be held at fair value on the balance sheet. If we were looking at held to maturity assets, those are ones that could be held at amortized cost. And then for B and C, we've got fair value with any unrealized holding gains or losses recognized in other comprehensive income or OCI, and then fair value as well, but any unrealized holding gains or losses recognized as profit or loss on the income statement. So the answer for this one is going to be B. We can take C out. We're going to recognize these paper losses, so to speak, in these financial assets in other comprehensive income. And that's just so we don't have these fluctuations quarter to quarter in the kind of net income of the company due to these unrealized gains or losses. So the net income can be a little bit more focused on the operations of the business, and then the OCI kind of includes these holdings and their gains or losses. Answer B. Question 45. A newly incorporated construction company reported revenue of $690,000, cost of goods sold of $550,000, and operating expenses of $210,000. Assuming a tax rate of 25%, the firm should most likely report a deferred tax asset of $17,500, deferred tax asset of $70,000, or C, deferred tax liability of $70,000. So to calculate this question, what we're going to do is we're going to take our profit essentially and figure out what amount of money that we are taxed on. So we're going to take revenue minus cost of goods sold and then minus operating expenses. And we see that gives us a $70,000 loss. And so if you're at a loss on your income statement, you don't have to pay taxes on loss. So essentially what happens here is we multiply this by our tax rate, so 25%, which is going to give us minus 17,500. And essentially what this gives us is we're going to be able to use this 17,500 asset in the future to offset other income. So we'll carry forward this $70,000 loss to offset future income. However, the deferred tax asset that we hold on the balance sheet needs to be multiplied by that tax rate of 0.25. So if we didn't multiply it, we would have ended up going with answer B, deferred tax asset of $70,000. But to get the deferred tax asset, we need to multiply by that tax rate. Answer A. Question 46. Argonne Pharma Limited reported a net income of $450,000 for the year ended on June 30th, 2017. The outstanding shares of common stock and convertible preferred shares are 40,000 and 10,000 respectively. So 40,000 in common stock and then 10,000 convertible preferred shares. And there's no other potentially dilutive securities. Each preferred share pays a dividend of $16 per share, and each is convertible into 2 shares of common stock. So you've got 10,000, but it can be converted into 2 per, so 20,000. What was the reported diluted EPS of the company? So there's a couple things here. So for our basic EPS that we would calculate, we would just take 450,000 minus the preferred dividends, which is going to be 10,000 times this dividend of 16 per share, and then divide by number of shares here at 40,000. 2 adjustments that we need to make here under diluting. If we convert these shares, we no longer have this dividend. So we would just have the net income in our numerator. And then in our denominator, the thing that would change is we would need to add in these additional shares. So 10,000 times 2, we would need to add in 20,000 shares. So here's what those 2 calculations look like. I'll start with basic EPS down here. Like we said, 450 minus 160. 160 is that dividend times 10,000 shares. And then you just multiply by the weighted average number of shares. So that gives us 7.25. Then the diluted EPS that change is the preferred dividends come out under this scenario. And then we need to add in 20 shares since that's the potential additional shares. So we get 450 over 40 plus 20,000 gives us 7.5. So this is where the last tricky part really comes in. Since our EPS went up under this dilution scenario, it's considered anti-dilutive, and so we don't report the diluted EPS that we calculate. We're going to report the basic EPS since it's anti-dilutive. So essentially, we want to report the more conservative number. So we will go with the answer B since basic EPS is lower. Question 47. The table below contains information that was extracted from the financial statements of XYZ company. Use the information to determine the effective tax rate of the company for the year 2015. So we've got 2015 numbers, so that's what we'll be looking at. We can we may need some information from 2014. So we've got income before taxes, tax payable, deferred tax assets, and deferred tax liabilities. So we will be using these numbers because we're going to need to know what the change in deferred tax assets and liabilities is for this calculation. So our effective tax rate is going to be income tax expense divided by pre-tax income. And the tax expense formula is a little bit longer here. So we've got tax payable, pretty straightforward. That's just going to be this 10,500 number. And then to that, we're going to have to add the change in deferred tax liability. So did this increase or decrease? And then subtract out the change in deferred tax asset. So whether this increased or decreased is going to adjust our tax expense. So our deferred tax liability did increase by 10,000. So we're going to have 10,500 tax expense. Then we're going to add 35 minus 25, so 10,000. So right now we're at 20,500. And then we subtract out that change in DTA, deferred tax asset. So we had an increase in deferred tax assets by 15,000. So we're going to subtract out that 15,000 now to bring that 20,500 down to 5,500. And then lastly, tax rate is going to be that 5,500 divided by this 88,000 number, which gives us 0.0625 or 6.25%. Answer A. Question 48. The financial data of unilateral equipment for the year 2014 is provided in the following table. So we've got net income, depreciation. So it looks like some cash flow related items here. Assuming a tax rate of 40% for the firm, the free cash flow to equity for the year 2014 is closest to. So we're going to be using our free cash flow to equity formula, which is a bit of a beast at times. But we're going to have net income, add back non-cash charges, so depreciation and amortization. We only have depreciation in this instance, it looks like. Then we're going to subtract increase in working capital, which is going to relate to decrease in accounts receivable as well as the increase in inventory. And then we can ignore interest expense and the tax rate since free cash flow to equity is going to be an after debt payment calculation. So we would be including interest expense in that tax rate if we were looking at free cash flow to the firm. So we've got increase in working capital, subtract out CapEx, which is just given as one line item here at 180, and then add any net borrowing. So we would add in debt issued, subtract out debt repaid. So we walk through all those. So we've got net income 700, pretty straightforward up at the top. Add back depreciation expense of 57. And then decrease in accounts receivable is going to be a positive for our working capital. So we add that back. And then increase in inventory is going to be a negative for our working capital. So we subtract out 36. Sorry, not a negative for our working capital. It's going to be a negative for our free cash flow. And then we've got minus 180 CapEx, which is just given as one line item. And then net borrowing will be debt issued if we add back and then take out debt repaid. So add in debt issued, take out debt repaid, and we get 710 million, which is going to be answer B. Question 49. Under which of the following economic conditions would the inventory value using the first in, first out method, so FIFO, most likely exceed the inventory value using the last in, first out method? So FIFO is going to exceed LIFO when inflation is increasing. So if this is time over cost of inventory, Sorry for the bad chart. If our price is increasing over time for FIFO, we're going to be taking these out of our inventory calculation, and then we'll be left holding these values up here, these inventory values up here at the end. So it will be greater than under LIFO, where we get rid of these values and then we're holding these down here. So we need to determine whether these are inflationary environments or deflationary environments. So A, stagflation. Stagflation is increased inflation alongside increased growth, or decrease in growth. So stagflation sounds like it'll probably be our answer, since inflation is what we're looking for. B, recession, and C, deflation. So deflation we can obviously rule out. B, recession. This one's a little bit more up in the air, since you could have inflation during a recession in theory. However, I think A is our best answer, since the definition of stagflation is increased inflation with decreased growth, whereas a recession, it's a little less indicative of what that inflationary environment will be like. So I think A is going to be our best answer, stagflation. Question 50. Which of the following statements regarding inventory valuation are most likely accurate? So we've got statements 1, 2, and 3 here, and then we need to determine which of these are accurate. So we've got 1 and 3, 1 and 2, or 1, 2, and 3. If we have 1 in every answer, in theory, if we were in a hurry on the test, we could just skip it, since we know that it's not going to determine our answer. However, for these purposes, we'll take a look. So is 1 accurate? Inventory costs should usually be capitalized. That is going to be a correct statement. 2, IFRS and US GAAP both allow the weighted average cost of method of inventory. That's also going to be correct. And then statement 3. US GAAP does not permit the use of last in, first out method of inventory. This one's going to be incorrect. US GAAP does permit the use of LIFO. IFRS does not. So we're looking at 1 and 2 as our correct answers. For A, we've got 1 and 3. B, we've got 1 and 2. That's what we want. And then C, we'll rule that out as well. Answer B.